In this video, I'll show you how to use the loan scenario details spreadsheet. This spreadsheet is a very powerful tool that allows you to quickly and efficiently pre-approve a client or client file without having to use a system such as Calyx Point or Encompass. This is like a preparatory move to qualify your client so that you don't have to spend a lot of time inputting information of the client into the Calyx Point, which is the next step after you pre-approve using this spreadsheet. So let's go through the spreadsheet really quickly. Let's assume we have a purchase. Say the purchase price is $200,000. Okay. Now the tax, you notice, has automatically been filled in, so as the insurance. And that's because I put in an insurance rate and a tax rate. And the tax rate is pretty much 1.25 for California, okay, for property tax. 1.25 of the sales price or the appraised value, whichever applies. So if you're processing a purchase, then it's a sales price. If you're processing a refinance transaction, then it's the appraised value. Insurance rate is just how much the property insurance costs per year. And in California, that's the case. And now if that's not the case, you can feel free to change that rate to reflect the accurate insurance and tax for that particular property. So let's go down to down payment. Let's say this individual wanted to pay 20% down payment. Okay. So the down payment would be $40,000. Total loan amount is the sales price minus the down payment, which is $160. And the interest rate, let's say, is 4.875. As soon as I do that, you see the numbers change over here. You see the taxes, the insurance, the monthly payment, and the total, what they call PITI, principal, interest, taxes, and insurance. Now if you wanted to change this to from a 30-year fix to a 15, simply do that, and you see the numbers change. Change it back. Okay, so that's how you use the top part. Now if for whatever reason, let's say if your down payment is less than 20%, say it's only 10%, then you're required to buy mortgage insurance, and then you have to put in the mortgage insurance factor, and that usually is in the 0.60% range. Okay, so 0.6% is 0.006 in decimals. As you can see, if you buy a property that's $200,000 and your loan amount is $180, and you have an insurance factor of 0.006, that comes to be about $90 a month mortgage insurance. Alright, so in our case, let's go back to 0 and that. And after you're done with the loan information, then you look at you input the borrower's income information, okay? So now you put in the first job. Let's say he makes $100,000, and that would automatically calculate a monthly of $83.33. And let's say it's husband and wife. So the wife, excuse me, makes $80,000. That's 66.67. And let's say they have some SSI income. Now with SSI income, which is retirement income, the only retirement income that you can count 100% or more gross is the Social Security. So if the gross is 1,000, you can count 1.25, which is $1,200. Okay. So So let's say they make $6,000 a year. So you might want to tamper around with this formula. But as far as gross income is concerned, this is the total income from all your income brackets. And if it's self-employed, you want to put down the average income, net income, found on the Schedule E. And there's a separate income calculation document that you can refer to. Now after you put in all your income, then you input your debt. Typically, there is a mortgage debt, and this particular borrower has a Chase credit card, $9,000 balance. The most important is the monthly payment. It's a minimum monthly payment, car payment, and student loan. So the total debt is this. Now how we arrive to the debt to income ratio is pretty much taking the total debt divided by the total income plus what's involved in the current transaction. So the total debt is actually this debt plus your existing debt, unless you're refinancing your primary home or the subject property, which then you have to back out your mortgage statement. Otherwise, you're double counted. You're counted once here and once here. So, in other words, your total debt will be this plus this divided by the income. And on the debt to income ratio, this is a very sensitive number, and this is the number that ultimately pre-approves you or not. The debt to income ratio, otherwise known as DTI, should be 55% or below. Anything above that needs to be proceeded with caution. Okay? And by the way, all these shaded cells do not need to be edited. So they're just for read-only purposes. And as a summary, basically you go down from left to right, enter all the information, the loan information, the borrower income information, their debt information, and what you'll get is a debt to income ratio and a total monthly payment. And that concludes our loan scenario detail spreadsheet usage.